the Finance Act, as well as IDF, going down from 3.5%.
RDL, His Excellency is asking, is the Railway Development Levy.
Yeah, these are acronyms.
Yes, yes.
So just use the RDL, say what it is, because it was your proposal that it be reduced.
Yeah, so we said that the Railway Development Levy was adjusted in the Finance Act from 2% to 1.5%.
Downwards.
Downwards. While the import declaration fee was adjusted from 3.5% to 2.5%. But remember, as we are, and our team behind me, you know, as
and also, if I remind you,
yes,
the RDL and IDF for LPG gas was completely removed.
Yes, yes.
And I thought my memory was having me right. I had to Google and check.
Yeah. So now our immigration was, when you look at August, the landing cost of oil was 108. I think this should be per liter, right? 108 shillings. Huh? In September, it went to 115.9. We try to debunk and see what is causing the change, right? Prices, international prices, contribute 46.82% of that cost, right? Now, because the way the Railway Development Levy is applied, so the only change, that's the extra change, was the Railway Development Levy, which grew by 7.69%, and the Import Declaration Levy, which went up by 7.66%. I'm doing VAT because VAT itself has huge significant contribution to revenues. So I'm not discussing that one. So our proposal, if we looked at some of these small things in a way, because it seems as if the Import Declaration Levy is levied on the CIA, cost, insurance, and flights. So as the price of international prices go up, similarly, this also goes up. So just thinking perhaps if we made it in a way that it no longer perhaps goes in line with the international price and find another way of measuring it, then perhaps it will lessen the burden a bit in terms of the total impact every month going forward.
Yeah, think about that, Mutembei, a little harder.
Just a thought against revenue collection that is from those particular heads. Yeah. So allow me, Chair, if you don't mind, to my dollar expert.
Those here. Yes, Nyaga.
Yep, thank you so much.
Omar knows where they are. Let's go get them.
I'm Robert Nyaga from PDO. Thank you, co-chairs, for this opportunity. On the exchange rate, my initial comment is that we need to address the issue about our exchange rate. It's a risk, and it can become systemic going forward. So I think the question was, what are the main causes? The main primary cause is too much imports relative to our exports. The difference between the two, I got some numbers here, is 5.8 billion US dollars, which is about 900 billion, which you have to finance. You have to find new dollars to pay for your imports. And therefore, when you look at the flows of remittances, the flows of other incomes, and exports, the second issue is the US Federal Reserve intervention in the market, basically to address inflation, which was caused by COVID. The inflation in the US was caused by them giving too much money to the public to consume. And therefore, they needed to remove that money from the market.
In subsidies?
Yes, in subsidy. So I think also subsidies have a risk if you overdo them. So when they started removing them by increasing interest rates, then what you're seeing is an outflow of capital. This includes money in the stock market or Nairobi Stock Exchange, and also portfolio investments, whereby people are buying bonds and treasury bills, going back to those countries to buy better instruments anyway. For example, if you're an investor and you are in US, what would you prefer to invest in? A US bond or a Kenyan bond?
Yes.
When the rates are high. So I think that's the issue. So the capital flow, and it's still going on, and that's why I'm saying we need to address this matter. It's still going on in the stock market. The Safaricom today is trading at 12 shillings 50 cents, down from about 40, I think 2 years ago. Number three, we have a more developed Nairobi Stock Exchange and a financial market. Our banks are more connected internationally. We actually have Kenya Commercial Bank, Equity, different in DRC, in Uganda. We also have a lot of MNCs, multinational corporations here, Coca-Cola, and many others. So when there's a problem in our economy related to fluctuations of our economy or even the dollar, they're more likely to move their money from our economy. So a developed financial market is actually can tend to bring that problem. And you're going to see this, which is similar to South Africa and Egypt. But to less connected economies like Uganda and Tanzania, we don't see such a big effect. And therefore, I'm able then to answer the earlier question, which is why is Kenya relative to Tanzania and Uganda, why is our shilling being worse off? So that is actually the main answer. And the other answer is FDI. FDI flows. The other issue is about speculation.
What about the FDI flows?
The FDI flows to Kenya have been lower compared to Tanzania.
Yeah.
What is it?
Well, it is
Clear, isn't it? You'd agree that we have lost our competitive edge to Tanzania. We heard that from the panelists.
Yeah, yes.
Tanzania is more attractive investment destination than Kenya. We should be asking our questions why. Don't justify.
The primary reason is
Yeah.
gas. Yeah, at this point in time, they're doing gas plants. Secondly, they're doing a big railway development. At this time, we did our SGR in 2013-15. But then they're doing it now.
2013 to 2016,
Yes.
and ended up
Yes.
taking it to the bush.
So now, right now what we are seeing is they're doing much better in FDI than Kenya at the moment.
Yeah, this
I could also explain in terms of food. We import more food than them. We import more food than them. Uganda, Tanzania. Let me give another explanation for that. Debt repayments and expectations around debt repayments, particularly the next year's Eurobond, which we took in 2014. Therefore, the markets, I mean, you and me, if you're in the market, you'll be worried about whether the country will be able to repay that that Eurobond, which is dollar-based, and therefore some people may be accumulating some dollars at home or in whichever way, or speculating on them, hoping. And I think this discussion is there. If you're in social media, people expecting the rates to continue worsening. And that's why in my proposal, we have to address the matter of the exchange rate. And finally, let me give the solution, because I just didn't need to just mention the problems that are providing other issues. One, remittances. Remittances is a quick win if we were to do it. And I think the current government is doing enough in terms of trying to airlift more Kenyans to Saudi Arabia and other countries. I think that's a good positive thing, which can help those flows to compensate for our imports. Secondly, address exports. Thirdly, macroeconomic interventions. One, inflation. When you're fighting inflation, you tend to raise interest rates. I would expect that to be helping us, but it seems it's not responding as much. The other issue is growth. If you improve your growth rate, obviously things are going to look better. But finally, Chair, is regulation. Do we have an opportunity to address the whole aspect about regulation? In 2011-12, I was involved in the committee which was addressing the sudden fall of the Kenya shilling that time. So this problem we had it in 2011-12. Again, Parliament formed an ad hoc committee, a select committee to address this particular matter. So I think this still need to have some discussion going forward on how you can address this matter. Exchange rate is one of the most risky prices if you don't get a hold on it. Thank you so much.
Thank you.
Yeah,
Thank you.
One additional information, Chair, is that I think from the supply side, we need to be a bit careful to address the supply side for cereals. Total imports, and cereals constitute 14% of total imports for 2022 and 2023 to date. 14%
Cereals
of total input is cereals.
from maize to rice.
Maize to rice and everything. So I mean, import require dollars. So from the supply side, we also need to address some of these bottlenecks of cereals being gotten from agriculture.
Couldn't agree more, Masinde, and I think it's the same point that Arthur was making in terms of enhanced investment in the agricultural sector.